Hello, everyone. I'm Doris Katrowski, and I'm a Senior Wealth Advisor at Canaccord Genuity. This is the first in a series of videos where I will be discussing the markets, investment strategies, and how to manage your money. The videos today cover the overall markets and how they are reacting to the Iranian and U.S. war. Global growth is set to gently slow down in the coming months as the effects from the war are beginning to weigh down on the economy. Financial conditions are tightening as investors are looking past the AI boom. Investors now are looking for value, for opportunities in undervalued and overlooked asset classes. In the US, the slowdown is expected to be mild, with business restocking and more capital investment. This combo allows manufacturers and retailers to pass higher costs on to consumers. This is terrible for the average consumer as disposable income has slipped and personal savings are now at a 4-year low. The US dollar has been pretty stable this year, even through the war. Businesses are now starting to show some signs of weakness. The US dollar is trading below its long-term average. US equities are no longer leading global markets. The US share of world exports have been slipping, while the US debt is growing year over year to all-time highs. With these scenarios taking place all at once, this is not a good sign for the US dollar. The softer US dollar does help the Canadian dollar. The lower US dollar tends to support performances of assets traded in Canadian dollars. While timing is hard to see where the US dollar resumes its downward trend, looking for investments that benefit from a weaker US dollar look pretty good right now. Oil prices have historically led economic swings, and we have had a pretty wild swing from the war. Price changes take time to work through the economy, and we should feel the swings in the coming months. Gold is still a valuable asset in any balanced portfolio. Prices have stabilized, and patterns from prior cycles suggest the correction is near completion. Oil prices spiked earlier this year for the obvious reasons, but should settle if the strait reopens. The price probably won't drop back to pre-war levels. There is still a lot of oil infrastructure across the Middle East that needs to be rebuilt. This all takes time. Many importers will need to rebuild their reserves, keeping the demand high. U.S. equities are still getting global attention from the high valuations on AI and tech, while other industries also continue to grow. Canadian corporate shares, in comparison, are looking much more reasonably valued. Foreign investment is returning to Canada, but still below levels seen in previous market cycles. Global emerging markets stand out with their cheaper valuations and strength from recent global shocks. In the end, growth is showing signs of slowing down without any major cracks forming. Investors are looking past AI and now looking for undervalued markets and industries across the world. This includes markets in Canada, Europe, Asia, and Latin America. The Iranians didn't help in keeping costs down. It shows the value of having a holistic long-term view on the markets, which helps portfolios continue to grow. Thanks for watching our video, and please feel free to like and subscribe to the channel if you want to hear more about this topic.